Good morning, everyone. You are watching a live daily market outlook for Friday, 9th of March 2012, prepared by Windsor Brokers. The long-awaited Greek swap is already behind us, as the Greece announced this morning results of the current bond swap getting 85.8 take up in swaps, and the main issue is that country currently avoids immediate risk of disorderly default. The Greece has said they averted today the risk of uncontrolled default, winning a strong acceptance from its private creditors for a bond swap deal, which will ease its massive public debt and clear the way for a new international bailout. The finance ministry said creditors had tendered 85.8% of the 177 billion euros in bonds regulated under Greek law. The rate would reach 95.7% of all Greek debt with the use of collective action clauses to enforce the deal on creditors who refused to take part voluntarily. The result should clear the way for the European Union and the International Monetary Fund to release 130 billion euros bailout package agreed with Greece last month. A government spokesman said that the result was a vote of confidence in Greece's stability to carry out deep structural reforms to its striking economy. He thinks that it's a historic moment for Greece, as he said in an interview to the local TV. It's a good news and it's a good success. French finance minister commented the news from Greece, and it's something that allows us to stay on a voluntary basis to avoid the risk of default. Under the deal, the biggest sovereign debt restructuring in history, creditors will exchange their old bonds for new ones with a much lower face value, lower interest rates, and longer maturities. This means they will lose about 74% on the value of their investments, but Greece's crippling public debt will be cut by more than 100 billion euros. The deadline for acceptance of the offer for bonds governed by international law and for state-guaranteed bonds issued by public companies has been extended to March 23rd. The Athens confirmed it would it will enforce the deal, activating the collective action clauses on the bonds regulated under Greek law. It will not be so easy to force holders of bonds governed by international law to come to the table, and that might trigger payouts on the credit swap CDS insurance that some investors held on the bonds, and an event which would have unknown consequences for the markets. The euro's immediate reaction was easing of yesterday's highs at 132.90, mainly due to the standard policy in the markets when the investors were positive on the expectations and then selling, basically buying the rumors and selling the facts, as the single currency versus the dollar is currently holding just above 132 handle after hitting levels close to 133 in late hours of yesterday trading. The shares were also higher on Greek release yesterday. During the Asia, the Japan Nikkei average jumped more than 2%, topping the 10,000 mark for the first time in 7 months, and also the Asia MSCI Asia Pacific ex-Japan index, which gained as much as 1.3%. The Pan-Asian index was set for a weekly loss of about 1.5%. However, as global growth concerns dragged the price lower earlier in this week before optimism over Greek took over. So we have a positive reaction during the overnight session on the Far East and world shares. More China easing is seen as recent data released overnight show economy slowing. The February CPI in China up 3.2% on yearly basis versus forecast for gain increase to 3.4%, and the January release that showed 4.5%. January-February factory output in China up 1.4% on a year ago, while forecast was 12.3%. January-February retail sales in China also were up 14.7% with forecast at 17.5%. China's annual consumer inflation, as mentioned, slowed sharply to a 20-month low in February, and the factory output and retail sales also cooled more than forecast, giving policymakers ample room for a further loosen monetary policy to support flagging growth. The expectations that Beijing will focus on growth rather than inflation were reinforced by data confirming the world's number two economy is losing steam, with the consumer price index easing to 3.2% last month, while factory output growth fell back to its lowest since July 2009. Fixed assets also, investments also slowed. This will allow People Bank of China to continue reducing the level of cash commercial banks must hold as reserves to keep money supply steady in the face of volatile foreign capital inflows, supporting growth without causing any inflationary spike. That's the comment from the analysts. Furthermore, from Germany, the data released today showing that German exports rose more than expected in January, widening the trade surplus and bouncing back after posting their steepest fall in nearly 3 years in December, as the data released earlier this morning showed. Data from Federal Statistics Office showed seasonally adjusted exports gained 2.3% in January on the month after downwards revised 4.4% fall in December. The median forecast was for 1.6% rise. The trade surplus widened to 14.2 billion euros from 13.9 billion euros the previous month, smashing the consensus forecast for a dip to 13.5 billion euros. Imports also rose more than expected by 2.4%, as imports were forecasted to rise by only 1.4%. Further to come today, the key release after Greece is the U.S. non-farm payrolls that are likely to grow solidly for a third straight month in February, a sign the economic recovery is becoming more durable and in less need for further monetary stimulus from the Federal Reserve. The economy probably created 210,000 jobs last month, according to the surveys, following January's tally of 243,000. The unemployment rate is expected to have held at a 3-year low at 8.3%. If the forecasts are accurate, the government's jobs report later today would mark the first time since early 2011 that payrolls have grown for more than 200,000 for 3 months in a row, an outcome that could bolster President Obama chances winning re-election. The improving labor market is another sign that the recovery is broadening and reduces the urgency for the Fed to act now. The analysts commented this. From today's calendar, we're going to take a brief look. As mentioned already, released economic indicators. Already mentioned the Chinese. Now we have a German CPI that came at 0.7% and increased, widened the trade balance at 14.2 billion. With the still to come from UK manufacturing production monthly at 9:30 GMT, a 0.3% increase is seen this month compared to 1% of the previous month. Industrial production in Great Britain forecasted lower than the previous month. 0.4% is today's consensus versus 0.5% of the previous month, and the same figures for monthly PPI output that is due at the same time. From Canada at 12 o'clock GMT employment change shows the forecast of increase by 14.2 thousand in February compared to 2.3 thousand in January, while unemployment rate is expected to stay unchanged at 7.6. Canadian trade balance forecasts narrowing the trade surplus to 2 billion Canadian dollars compared to 2.7 billion Canadian dollars in the previous month. Labor productivity quarterly in Canada due at 1330 as shows increase by 0.6% compared to 0.4% of the previous month. And the key releases are 1330 U.S. non-farm payrolls. As said, the forecast is 210,000 increase compared to 243,000 of previous month. 8.3 unemployment expected to stay unchanged, while U.S. trade balance is forecasted to widen. The trade gap actually is expected to widen slightly to 48.9 billion US dollars compared to 48.8 billion US dollars of the previous month. We're going to now take a look at the markets. I think you already see the charts on your screens. Starting with Europe, as mentioned, the positive structure in past couple of days remained of 130.95, 131, where the pair found temporary support on the broader descent of 134.85 double top. But investors started clearing their positions after positive news started coming from Greece, and currently the pair is descending. So far 132.11 was seen, and its important current attack at 55 days exponential moving average on the hourly chart with the break here and the loss of 132.00 around figure support and handle to further weaken the structure and possibly to end the current corrective bounce that reversed exactly 50% of the down leg from 134.85 down to 130.95. The hourly studies are pointing lower, although holding still above their midlines. All the studies are in the facing south, and this might increase risk of further, keeps the downside vulnerable, and might risk increase of further easing, while 4 hours structure is losing momentum, but we see MACD is now breaking above, attempting above its midline. However, the other studies are still pointing lower, and 20 days moving average on the 4-hour chart comes under pressure now. A break below 132 asset might risk further easing and possible retest of 131.00 below, which is to signal a resumption of the broader downtrend of 134.85. To avert immediate downside risk, we need to see base above above 132.00 and regain of minimum 132.90 yesterday's high in order to open way for stronger recovery. 133.36 is the next Fibonacci 61.8% retracement, and the 132.55.60 zone, that was the previous break point, regain of which is required to refocus tops at 134.85 and confirm basically the higher low at 130.95 posted yesterday. The cable is our next instrument. Also the latest recent gains of 157 base, where the pair found a temporary support as a part of the broader down move from 159.91 peak and the break below 200 days moving average. As I said, temporary support was found at 157 zone, averting immediate risk of testing critical support at 156.50, but the gains were limited at 158.30 area for most of the time during the yesterday's trading, as the first time the high was hit at 9 o'clock GMT, and they kept the upside limited during the rest of European and whole American session, as well as overnight session, with further easing seen during the overnight and early hours of today. So far, the 55 days exponential moving average holds the downside, keeping hopes of a higher low at this zone, and this is just ahead of the next significant support at 157.70, yesterday's intraday's lows, and a more significant previous range ceiling that was acting as a very strong resistance. Currently this is reverted to support, and basically holding above these levels would keep the prospect of further extension higher. The hourly studies are regaining momentum while the others are still in positive territory, but off their strong points, slightly pointing lower. That might increase, that might keep actually the downside still vulnerable. We need to see regain of 158.30 and break above this level in order to attract more significant barriers. The first one comes the very strong resistance at 158.80, which is the previous high of 6th of March, and 200 days moving average false break of which we witnessed during the past week, when the pair broke higher, hitting levels close to 160.00 and then quickly reversed lower. So basically, on the broader on the wider picture, we need to see break above this level. I would say is a critical near-term support in order to refocus, to break first above the 1 month range that is limited at 159 and 156.50, and to refocus previous highs at 159.90 and 160.00. Failure to reclaim this level might risk lower top and a further range, while loss of a strong support at 156.50 would significantly weaken the larger picture structure of cable, and possibly open way for test of levels set towards 156 and 155 zone. Hourly structure of dollar yen shows the pair weakening under the corrective mode after hitting marginally fresh high this morning at 81.88 against the previous one at 81.85, but failing to sustain gains, and the subsequent reversal so far found support at 81.45. This is just above 55 days moving average on the hourly chart at 81.39. Studies, as said, hourly studies are pointing lower, and the downside remains under pressure, with further easing seen towards the next level at 81.30, which is the intraday low of 8th of March 2012, below which to possibly open way for a stronger correction. Key support on the near term is at 80.60. 81 comes first as a round figure support, and then 80.60, and only break here to significantly weaken the current structure, as the pair is currently entrenched within 81.88 and 80.60 range, and the break of this level to delay immediate bulls in favor of stronger correction, and possibly to bring a key support of the short term at 80.00. Holding above 81 would keep the upside in focus, with the break above today's high at 81.88 to open way for further extension of the broader uptrend from 76 base. 82.00, 82.20 and 82.50 would be the next upside targets in case of break higher, while, as mentioned, the loss of 80.60 would delay and would question the short-term bulls. Dollar Swiss recent reversal, we can see on the broader picture, of 92.00 peak of 7th of March, has retraced around, actually almost exactly 50% of the initial up move from 89.30 to 92.00, where the temporary support was found. The hourly structure still holding below the midlines, but pointing higher, as the pair broke above 20 days moving average at 91.00, which was also the initial resistance as around the figure resistance, and currently attacking the 91.20 55 days exponential moving average, above which to signal a stronger recovery. We need to see break above 91.55 in order to resume the recovery, and the test of 92.00 yesterday's high. Break of this one to continue the gains of 89.30 double bottom and open next significant levels at 92.50 60, and the critical support and key trigger at 93.00 high of 16th of February. Daily structure, the studies are pointing higher, although still slightly below their midlines, but improved structure after break of the main bear trend line drawn of 95.73 mid-January's high, keeps the upside in focus. The pair is currently attempting above 20 days daily moving average, with the clearance of 92 and the 90 and 55 days moving average at 92.50 zone, which is also the equivalent to the previous range ceiling, to refocus our key barrier on the upside at 93.00. On the downside, the loss of current recent low at 90.70. At 90.70, yeah, would risk further reversal. 90.36 would come next as 61.8 Fibonacci retracement, and that will be a confirmation of a lower top at 92.00 ahead of a possible extension lower and test of a key near-term support, double bottom at 89.30 zone. A quick look at gold. It remains in the recovery mode of recent low at 1663, as regaining previous low at 1686 and more significant 1700 level. However, the gains still being capped by 1704, 1705 previous lows, and the range floor that is now acting as a strong resistance, as well as daily 55 days moving average at this point, currently capping the upside attempts. Further upside, we have our next very strong resistance and a recovery high at 1725, which also marks 50% retracement of the down move from 1790 down to 1663, pardon, a break of which is to avert immediate downside risk and open way for stronger recovery. 1742, 61.8 Fibonacci retracement, and possible test of 1790. On the daily outlook, the studies are still negative as MACD breaks, as well as momentum below their midlines, keeping the pressure at the downside. As I said, the previous lows and range floor at 1704 so far caps the upside, and another obstacle that we have at 1725 stays intact for now. Immediate risk will be seen again on the renewed attempt at 200 days moving average, currently standing at 1679, as we have already witnessed one false break here when the price extended to 1663 after breaking the moving average, but quickly reversed back. So to summarize, holding below 1705, 1725 would keep the downside vulnerable, and loss of 200 days moving average at 1679 and previous low at 1663 to further significantly weaken the structure, possibly for test of immediate support at 1656, 50% retracement, and 1625, 61.8 Fibonacci retracement. That would confirm the lower top at 1790 against 1802, the previous one posted on 8th of November 2011, and possibly resume the stronger reversal, stronger downtrend of 1920 record high of yellow metal posted on 4th of September 2011. Thank you, and I wish you a nice day.